All right, my name's Greta, and I just wanted to welcome those of you who just joined. We'll be getting started here in just a couple minutes, so hang tight, go ahead and mute yourselves, and we'll be right back with you. All right, well, welcome to the COVID support webinar series hosted by the International Nanny Association. Today, we are going to be looking at the U.S. COVID relief and how it will affect you. Our speaker today is Tom Breedlove, and I'm going to let him introduce himself here in just a minute. But first, wanted to do just some housekeeping things to let you know kind of how we're going to proceed this morning. First of all, this webinar is being recorded, so just know that this will be available on our YouTube channel afterwards. Please do keep yourselves muted. It's up to you if your video is on or off. We will be letting you put questions throughout the webinar in our chat. So find the chat button and you can submit questions throughout. Tom will give us some guidance on how he'll proceed with questions throughout. And if there are any questions, you can definitely message me as well. My name's Greta. Did I introduce myself? I'm Greta. I sit on the board for the INA and just really excited about today's webinar. And Tom is a veteran in the industry and excited to hear the information he has to share with us. So Tom, why don't you tell us a little bit about who you are and jump right into our webinar today.
Great. Well, thank you, Greta, and welcome everyone. My name is Tom Breedlove. I'm Senior Director of Care.com HomePay. For those of you who don't know a lot about HomePay, we are a compliance service, so we handle all the payroll, taxes, insurance, and labor law, and everything that goes into being compliant and being paid professionally. And we've been doing that for about 30 years, of which I've been a part of the company for about 15. So I've been around a long time and probably met many of you at INA conferences. And I'm happy to share this American Rescue Plan because it's really got a lot of really good news for a lot of people. And I think it's going to be really good for the industry. So I'm really excited to share everything. And what I'm going to do I think I'll just start with kind of an overview of all the key things that the law includes. And I know probably a lot of you have read pieces of this. And so some of it may not feel like new news, but hopefully it'll all be in one place and it's all going to be kind of looked at from our industry's point of view, as opposed to the general media. And I'll just pause at the end of section 1. We'll go through all the components of the new law, and I'll kind of pause at that point and make sure there aren't any questions. And Greta, maybe you can help me. I guess if people do have a question, jot it down, send it in the chat or whatever. And then when we get to that point, we can hit those real quick and make sure we're real clear on the law. And then we'll spend a couple minutes just talking about the industry impact and some of the resources that we've made available to try to help everybody through this. And then we can kind of finish it with some more Q&A too at the end if we want. Okay, so if you're ready, we'll just dive in. The new law, it has a lot of good stuff, like I said, and I think everybody has heard about the stimulus money. Just to be real specific, it's $1,400 per person. If your adjusted gross income is less than $75,000 for individuals, if you're a couple married filing jointly, then your income, your AGI needs to be less than $150,000, and if you're a head of household, it has to be less than $120,000. Now, if your income is slightly higher than that, there is some money available. But it phases out pretty quickly once you get over those AGI amounts. And I should say too, from an accounting point of view, there is a difference between household income and adjusted gross income. That AGI number is actually lower than your income because the way they calculate it is your income. Then there's a bunch of exclusions to that, which gives you gross income. And then there's a bunch of deductions from that, which gives you adjusted gross income. So if you're a nanny and you're making, $80,000, let's say, you might still be under this threshold. or 85 even, because of that adjusted gross income will be less. And if you have, if your family might be making 180,000 or whatever, they still might fall under this 150 threshold for couples. So just keep in mind that adjusted gross income is lower than household income. Also really good news is that the dependents also get money as well. So a family of 4, you probably read this, a family of 4 could get up to $5,600. And the really good news is for a lot of folks, they're already starting to see the money in their bank account. So if you paid your taxes and the IRS has your bank account, if you paid electronically and you did the direct deposit, then they have your bank account on file. You might have already started showing up over the weekend. I think checks are physically going out this week. So if you fall into one of these categories, hopefully help is on the way really, really soon. So that's the stimulus stuff. Let's talk a little bit about the Child and Dependent Care Tax Credit. Now, like I said, I've been in the industry for about 15 years, and they have not raised the expense limits for these care credit, for the child care tax credit my entire time. And obviously the cost of care has gone up a lot. So this was really long overdue. But if you have one child, you can basically you can itemize expenses up to $8,000 now. Now it used to be $3,000. And that would include whether you have a nanny or whether you have daycare, any kind of child expense, child care expense, as long as that child is under the age of 13 or physically or mentally unable to care for themselves, they would qualify. Then you can itemize these expenses, and the cap has grown demonstrably from 3,000 to 8,000 and this is if you have one child. If you have 2 or more children, the expense limit has grown from 6,000 to 16,000. Okay, so that's a huge jump. And not only has the amount of expenses increased that you can itemize, but the tax credit percentage has also increased, which is really, really good news. Now it's kind of a complicated formula the way they do it because it's all based on income. But essentially, most families, a year ago, most families would only get 20% tax credit. So let's say you had 2 or more children, you multiply the 20% times the 6,000, and you would take you'd get a tax credit of $1,200, or up to $1,200, I should say. Now, with the tax credit percentage increasing and the amount of expenses being itemized increasing, that same family could see as much as 50% credit on $16,000. So that would be $8,000. So you can see that that it's a huge jump for a lot of families. Now, as you start making more, probably if there are nannies in the audience, they're probably thinking about their families. Depending on how much that family makes, they could. I would say, it's going to start to taper off as they start making more money. When you get into $300,000 or $400,000, you're going to see numbers closer to the 20%. But just for I think for easy math, most families will see savings of at least $1,600. And if you have two or more kids, you're going to have $3,200 probably or more. And I think what you could also say from all this is that some families will see that even double or even more because of the tax credit. So it's a lot. It's a really different ball game now for folks that have that don't have an FSA and need to use the child care tax credit. It used to not be that much of a tax break, but it is a pretty powerful tax break now. And another little feature of it that is really good news is that it's considered a refundable credit. So what that means is that if the tax savings actually exceeded how much you owed in taxes, your total tax liability, you would actually get a refund back. So it's not just wiping it down to zero; it can actually be a refund back. So that's really good news. And this is a 1-year provision in the law, so it's set right now to end at the end of 21. but there are already talks underway that it might be extended to 2022 as well, and possibly beyond, because like I said, these tax breaks have not been increased in so long that I think everybody realizes the cost of care has gone up so significantly that it's time to start raising these dollars. Now, I mentioned the flexible spending account. Just to be clear, there are medical flexible spending accounts that some families can take advantage of through their employers. There's also a dependent care flexible spending account, which focuses obviously on dependent care. That has increased as well. It's more than doubled from $5,000 a year per family to $10,500 per family per year. So that's a huge increase in the expense limit for FSAs. And so what that means is that the families then have to multiply that expense, that total number for the expenses up there, and multiply that by their marginal tax rate. So everybody has their own marginal tax rate depending on what tax bracket you're in. I would say a lot of the families who are employing nannies will probably end up saving between $4,000 and $4,800, depending on how much they earn. So that's a big leap. Again, that's more than double from what it was last year. Really, really good news. And then I'm kind of a combination platter kind of guy, so I kind of like to think about these things in tandem. And there are some families who actually get to take both of these tax breaks, which is even better news. If you have more than one child and you have access to an FSA through your employer, you can use both tax breaks and save about $6,000. That number again is going to slide around depending on marginal tax rate and also the household income from the child care tax credit. But you're able to apply those dollars to the FSA and then take the leftover dollars and use the child care tax credit, and the combination of the two can save some families as much as $6,000. Again, this one, the FSA is supposed to be sunset at the end of 21, but there's already talk about extending it as well. And I think the bottom line for most families when it comes to the tax breaks is the tax breaks. There's some combination of these tax breaks, either one or both, will cover, for most families, cover the cost of compliance. I know that people oftentimes are reluctant to pay on the books because they fear the cost of compliance will just be too high. But what we're seeing now is that the cost, they'll be able to cover the cost of compliance plus some of the nannies' wages just by taking advantage of these tax breaks. So you have to pay legally in order to get these tax breaks, but if you do, you're going to end up saving more than the cost of the taxes, and even the insurance and a payroll service cost and all those other things can be covered by these tax breaks. So it's really a great news story for a lot of families who've been struggling with the cost of care and have been struggling to put their nanny on the books, maybe because of cost. So all that's great news. Now, not to be confused with the child care tax credit, there's another thing called the child tax credit. So if you're a nanny and you have a child, or if your families, because they have children, they'll be able to probably take advantage of this tax credit. And what they did is they increased it to $3,000 per child if your child is between the ages of 6 and 18. If your child is under the age of 6, 5 and under, you would actually get $3,600 per child. So that's an increase. It used to be $2,000. So this is essentially 30%, 50% more, and in some cases almost 100% more. My understanding of the way that this money is going to be rolled out is that about half of it will fall in monthly installments from July through December, and then the other half would be applied to your tax returns at the end of this year. So families should start seeing some money rolling in by July, and it probably would be about $300 a month or so. Okay. Oh, I should mention too that that there is a phase out on this. If you earn more than 75,000 as an individual, 150 as a couple, or 112,500 as a head of household, the credit starts to reduce. And the way they calculate it is $50 reduction for every $1,000 over that threshold. So if you were an individual and you made, let's say $95,000, that would be $20,000 over. So it'd be 20 times 50. Your reduction would be $1,000. Okay, so you would get, say, $2,600 instead of 36. Okay, so you can kind of do the math on that, but just know that there's nice money for folks in this. Okay, now the earned income credit is something very few people really take advantage of or know much about, but they did expand it within this American Rescue Plan, so it's worth mentioning. It is for those that don't know much about it, it's a refundable tax credit, and it was really designed for low and medium wage earners. In the past, it was really focused on helping low and medium wage earners who had children, because of the way they do the monetary payouts and also the income restrictions. It was usually built around how many children you had. So the more children you had, the more money you got back. And it was as high as $6,700. So it's a lot of money. It reduces your tax liability by $6,700. And if you only had $5,000 in tax liability, you would get $1,700 back. So it'd all be wiped out plus the extra. So it's a really good program for low and medium wage earners, but it has traditionally not done much for those families who were non-parents. So if you didn't have a child, you really didn't get much money, but they tripled the benefit this year from about $500 to $1,500 for non-parents. And then they increased, they held the other ones the same, but there's still really nice benefits, like I said, up to $6,700. And then the other thing they expanded was the age for those who can qualify. It used to be 25, and if you were over 65, you were excluded. They've now basically taken the age brackets down to 19. So if there's young nannies out there, you'd be able to take advantage of this. If you were 22 or 23, you can now take advantage of it. Or if you're over the age of 65, you can also take advantage of it. So that's really nice. And then we also have unemployment benefits. Now that the way this has worked over the past few months, or really, I guess, since COVID kicked in, has been that the state and unemployment benefits have been boosted by some federal dollars. So federal is kicking in. Right now, they're kicking in an extra $300 a week to help folks who have been laid off due to no fault of their own. And so that's kind of our unemployment program. The good news is this has now been extended through the end of August. So the money's the same, but instead of letting this expire for those people who are still struggling to find a job, you'll be able to continue to get the full federal boost all the way through the end of August, which is really nice. And another piece of this is that they said that the first $10,200 in unemployment benefits will be considered non-taxable. So that's nice, because typically unemployment benefits are taxable. I think my understanding of the way this is working is that, if you've already filed your 2020 return and you paid income taxes on any unemployment benefits for last year, then you can actually get a refund. Now, most people probably haven't filed their 2020 return yet, so just make sure that whoever's doing your account, your tax filing, make sure that they know that you had those unemployment benefits and you should get this benefit, this non-taxability of it. Okay, paid sick leave, and I think we're almost through with all the key points, and then we can take a breath here and talk about it. So paid sick leave. The FFCR, the Families First Coronavirus Relief Act from last year, had paid sick leave and family medical leave benefits in it. and they were essentially expiring. If you'd used them, you didn't have those days to use in 2021, but they have decided to kind of reset that. So now you have up to 10 days of paid sick leave available. If your family chooses to offer it, they can pay you for this, and they would be reimbursed at 100%. So there's really no reason for families not to, if they're paying on the books, and they would get a reduction in their federal income taxes. So they would be able to get any paid sick leave back from the government. So the good news is that in addition to if you or a loved one had coronavirus and you had to take some time off, you would be able to do that. But the other thing it's covering now is vaccination. So I know there are some places like near me where you have to wait all day in line to get the vaccine. You might have to do that twice. If that happens to you, you'd be able to take those days off, and they would be paid days, which is nice. And your employer can pay you for those days and then get reimbursed. So it's a nice safety net for everyone to have, especially during the pandemic. So, okay, so that kind of covers the big provisions in the law. I know I covered a lot of stuff really quickly, so I want to maybe pause here, and Greta, if there are any questions, maybe I can try to clear things up.
So we haven't had any questions come in through the chat, but I will welcome everyone. This is a great time to type those in. We've had several people join since we got started. So this is being recorded and will be available on our YouTube channel. There's a lot of great details that Tom went through. And so if you want those statistics and that information, it will be available to replay. But please do type any questions in the chat, and I'm happy to pass those on. Looks like you did a great job, Tom, and you were very
so crystal clear that there's no questions. All right. Well, it is it's fairly straightforward. And I think a lot, like I said, a lot of this probably many people knew or had read some of this. So that's good. I'm glad people are kind of getting it. And obviously there's still some level of minutia and detail that is still coming out. And I feel like every day I'm still learning something new, but it's really in the nitty gritty. So there's just a lot of good news. I hope everybody's just smiling about the good news, and we'll worry about the details later.
I will ask you, Tom, when you talk about the AGI, does that mean they're looking at the year prior, like what has been filed, what they have on record, rather than the current year?
Yeah, my understanding of the way it reads is 2019 or 2020 can be used to establish the AGI. So you're essentially, going to be using, the IRS will be looking at those figures, and they'll give you the relief if you warrant it from those. So I think there's some, I'm not 100% sure how the IRS is looking at that. I don't know if you were below the threshold in 2019, if it behooved you to wait, if you thought you were making more than the threshold in 2020, there's probably some gamesmanship like that. You might talk to whoever's filing your tax return, just make sure that you don't disqualify yourself. But I think the fact that they're sending out all the money already before the tax returns are even due, it means that they're almost, they're basing it on 2019 probably.
Okay. I do have a question that just came in. So as an employer, are we required to offer 10 paid days off for sick leave? If so, is this for both part-time and full-time employees?
It's voluntary for 21. It was mandatory last year, the paid sick leave, but in 21, employers don't have to do it. But like I said, it's completely reimbursable. So it really is something that I think everybody should do, but it's not mandatory, it's voluntary. And the eligibility on the part-time, yes, basically what they do is they're the 10 days, you're paying whatever their rate is for those 10 days. So if they were part-time, the daily rate would be smaller in essence, but they're able to still take the time off and they're able to get that money back.
Okay.
the family's able to get that money. So hopefully that's
Great.
somewhat clear.
Another question, is there anything proactive that we need to do to take advantage of these new adjusted benefits, specifically FSA, or will it automatically adjust when we file taxes?
Well, the FSA is one where you have to enroll in that through your employer. So if you're talking about someone who's got access to a program through their company, there's going to be a cafeteria plan where you have to enroll, and you typically do that in the fall before the year, and you basically work with your HR department to say, well, I think I'm going to have either daycare or nanny care expenses of X amount, and they will then tell you, okay, then you're going to want to set aside the full $5,000 and make that pre-tax. You're paying for those costs with pre-tax dollars, and that's the way it's always worked. Because this is now, a lot of people have enrolled in 21, and they probably enrolled at the max of $5,000. So what will happen now is everyone who has this program will need to circle back with their HR department and say, hey, I want to expand this to the $10,500. I want to take advantage because I've got a nanny at $30,000 or whatever. So I want to cap this out or max it out and take the full $10,500 so I can save more. And this is, you basically have a chance to do that. And if you didn't enroll in your FSA before the year, there are life-changing events that allow you to enroll mid-year. So my understanding is that this program would qualify as a life-changing event. Although I know there's a lot of latitude for how companies administer this program. But I would definitely talk to your HR director if you have access to one of these programs. And if you say, hey, I didn't enroll last year, but I'm, putting my nanny on the books this year or whatever, and I want to make sure that I'm getting the full $10,500, they will likely put you on the program and let you enroll mid-year. So there's a whole bunch of things that actually qualify as life-changing events, and this change in the law is supposed to be one of them.
Okay.
Now, on the child care tax credit, though, that one should be applied automatically, because that one is, you're going to, well, I say automatically, if you use like one of those wizard, like an online tax form, they're going to essentially ask you some wizard questions. And if you tell them that you had child care expenses and you don't have an FSA, they're going to put all the money into the child care tax credit and give you the appropriate percentage, and it'll automatically be handled. If you have an accountant who's doing it, and maybe, or you're doing it yourself, there's a form called 2441, and that is the form where you itemize the expenses, and then you have to fill it out with either the daycare's employer identification number or your nanny's social security number, and that's how you take advantage of that tax break if you're doing it kind of the old-fashioned way.
Okay, great. Those are all the questions we have at this
point. Okay, we'll have some more time for questions at the end if we need it. Okay, so the impact on the industry, I think it's pretty obvious, but I want to kind of hit these. I think we're, the really great news for nannies, and I hope there are some on the call today, is that benefits and protections, the safety nets that you deserve as a professional, those have increased. Now, we've always talked about Social Security and Medicare, and we've talked about unemployment and disability and all the other things that you get when you're paid legally, and that's all great. But this year, it's, you can see that it's even better than ever. So I think that's really good news I know that INA, I think in the last survey, Greta said that I think 60% of INA nannies are paid on the books. But I know there are a lot of nannies who are not paid on the books. And, the argument for having to defer some of your income or forego some of your income now for benefits when you retire, some of that feels like so long from now that a lot of people just say it's not worth it. But when you start to look at all these other benefits and protections and stimulus and all these other credits and things, you start to go, you know what, it really financially will make sense for most folks to be paid on the books. And the obstacle that your families sometimes have about putting you on the books, the whole, this is going to be too expensive or too difficult. Those are going away too now because of the tax breaks for families, for parents with care. It's enough to cover all of the tax costs, like I said, but also services to help make all the pain go away, to make all this easy. You know, you don't have to worry about doing paperwork on your weekends. You don't have to do all that. You can get workers' comp insurance, and you can take care of all the taxes and everything and still come out ahead. So now the nannies are getting more benefits, the families are getting lower costs. I think all of that, to me, says that it should be really good news in general, and we should have a rising tide that will kind of lift all boats. I think you'll see more jobs, more placements if you're a nanny agency. And I think all that's really good. I think we're going to see professionalism and the quality of a lot of these jobs continue to go up. There's no question that we're also going to get, you know, all of you in the industry, whether you're a nanny or a nanny agency, you're probably going to start to get a lot of questions from families about legal pay. How do I do this? I know I want to give you these benefits, but I don't really know how. And so I think, you know, the need for resources and support is probably going to be great for a little while. I would think over the next few months, there's going to be a lot of questions from a lot of different angles on this thing. How do I take advantage of it? So I did want to share a few things that we can do to support you. These are all free and don't require you to, you know, purchase HomePay service or anything like that, or your families to even purchase HomePay service. These are just things that we want to offer up. We have a couple of new materials. One is called the 21 Tax Breaks for Childcare, What Every Family Needs to Know. And the other one is called Why Being Paid Legally is Smarter Than Ever Before. So if you're a nanny and you're trying to talk to your families, that tax break thing might be helpful. If you're an agency and you're trying to talk to families, hopefully that would be helpful. Or if you're an agency talking to nannies, or maybe a nanny talking to friends in some of your nanny groups about being paid legally, maybe these documents will help. We have them available in PDF form. So if you need this, just holler at us and we'll get them to you. We also are updating our online calculators. We have budgeting calculators for families to figure out how much it will cost to pay legally. So you have to factor in the employer costs, but also the tax breaks. So now that the tax breaks are a lot higher, we're updating those calculators, and we have it through mobile as well as desktop. And so if anybody wants to run numbers, they'll be able to do that on our site. We also have a team of people who are set up to provide assistance. So if anyone, whether it be a nanny, a family, agency, if anyone has any questions about budgeting and what will this look like on this particular client, we can certainly help with that. And we also have, I wanted to bring this to your attention, if families are kind of daunted by getting tax IDs and all that kind of setup stuff that can kind of come into play with being legal, we actually have a program called Smart Start, which it provides the family with a free month of trial where we take care of everything in the setup. And get them off to the start that they need, get payroll set up, get tax IDs set up, file the new hire reports, make sure that payroll is running smoothly, withholdings are done properly. And we'll give them that at absolutely no cost through the INA agencies and partner agencies are able to offer this to their families. And it's just our way of saying, hey, we want to make sure that people get set up correctly and get this handled correctly. They don't have to continue with our service. So there's no obligation to continue, but we feel like if people get off to the right start and they do it at the time of hire, everything runs a lot smoother. If they wait and talk to their tax person at the end of the year, by then there's all these mistakes and problems, and it ends up kind of causing a lot, a lot of headaches and hassles, and frankly, more expense. So really the solution from our point of view is to just deal with this at the time of hire. And if we can take on all the barriers of cost and hassle, make it easier for families to get started, then we feel like we've contributed a little bit to the industry. So we want to make that available too. And then I'll just wrap real quick. I think everybody knows a lot about HomePay, but we've been doing this for a long time. Like I said, about 30 years. We do have a comprehensive service where the family is our client, and we take care of their nannies as well as any other employees they might have. And we have very proud of our customer service. We've won multiple Stevie Awards now for excellence in customer service, because it's really important to us that families get really good service. We know they're busy, so we want to make it fast and simple and easy. And we partner with agencies to support this whole program. So that's a little bit about HomePay. That's really all that I have on this topic right now. But as things come up in the coming months, there may be new information, in which case we'll have it on our site, or you can call us at any time, and we'll make sure to get you all the updated information that you need. So thanks to everyone for joining. And if there are any last minute questions, I'm happy to try to answer.
Yeah, Tom, I'll ask a question and just give a couple minutes for anybody else to submit a question in the chat. But talk to us a little bit about the stimulus and what nannies need to do at the end of the year to make sure they're taking care of that with their taxes.
Well, the stimulus would be automatic if you filed your tax return from last year or the year before. If you haven't filed taxes, my understanding is that you can file taxes in the coming weeks before the tax deadline, and that there will be a stimulus check automatically provided to you if you qualify after the fact. So, if we're talking about in April, you file your taxes, if you deserved a stimulus check, my understanding, and you hadn't been paid legally before and you hadn't already received it, my understanding is that they would then pay you. So I don't think there's anything really that you need to do. If you haven't been paid on the books, I would say just get yourself on the books for this year. See if you can get your family to provide you with a W-2, or you can always do a write-in W-2 if you need to. But if you report your wages for last year during this tax filing season, the stimulus should happen automatically. And Greta, I think you were asking earlier about whether there's any income taxes associated with that. And my understanding is there's not. This is all tax-free.
Okay, great. Well, I don't see any other questions coming through. Tom, this has really been a great overview of everything. Thanks for being with us here today. And if everyone will just note myhomepay.com, I think you can head there for resources or to contact HomePay about some of those PDFs, the calculator that Tom talked about. And again, this will be available on YouTube, so feel free to find it there, share it. I think this is great information that we're going to continue to circulate in these next coming days. So Tom, thank you so much.
Thanks for having me.
All right, everybody have a good one.
Okay, bye-bye.
Bye.